Money Saving Minute number 009, How Credit Scores Are Calculated. When credit is run, the three most common questions are, what are my credit scores? Are those scores good or bad? And how is that number calculated? Credit scores are calculated using several different pieces of credit information. This data is grouped into 5 categories. Each category is weighed differently and is expressed in the form of a percentage. Your credit considers both positive and negative information in your credit report. Late payments will lower your FICO score, however, establishing or reestablishing a good track record of making payments on time will raise your credit score. These percentages are based on the importance of the 5 categories for the general population. Every individual situation is weighed slightly differently. In other words, this is the guideline, not the rule. This is the most important factor in your credit scoring. A few late payments can have a large impact on your credit score if you have limited credit. The more trade lines that you have in good standings will determine how quickly you will earn these points back. Please note, however, having no late payments in your credit report doesn't mean you'll have perfect credit. Your payment history is just one of the 5 factors in calculating your credit score. Owing money on credit accounts doesn't necessarily mean you're a high-risk borrower. However, when a high percentage of a person's available credit is being used, this raises the risk level for the lender and therefore lowers the credit score. Note that even if you pay off your credit cards in full each month, your credit report may show a balance on these credit cards. The total balance on the last statement is generally the amount that will show on your credit report. In addition to the overall amount you owe, your FICO score considers the amount you owe on specific types of accounts, such as credit cards and installment loans. Carrying a very small balance without missing a payment shows that you manage credit responsibly, and having a low credit utilization ratio is a plus for your credit score. But you need to have credit in order to have a credit score. The misnomer that by paying cash for everything means that you have great credit is false. Cash is king, but it doesn't buy you 700 scores. Also, closing unused credit accounts that have zero balance and are in good standing will not raise your credit scores. As a matter of fact, they may actually lower your credit scores because you are reducing your utilization ratio. If an unused account is costing you money in annual fees, however, then closing the account should be something to consider, but only if you have other accounts reporting favorably for you. In general, a longer credit history will increase your credit scores. However, even people who haven't been using credit very long may have good credit scores, depending on how the rest of the credit report looks. Your FICO score takes into account how long credit accounts have been established, including the age of your oldest account, the age of the newest account, and the average age of all of your accounts. Scoring also considers how long a specific credit account has been established and how long it's been since you used a certain account. This plus your utilization ratio are why short-term loans do not help to reestablish bad credit. A high-interest 12-month loan from a store might get you a new TV, but it's not going to get you a higher credit rating. Reestablishing credit takes time and proper tools. Scoring will consider your mix of credit cards, retail accounts, installment loans, finance company accounts, utilities, and mortgage loans. The credit mix usually won't be a key factor in determining your credit score, but it will be important if your credit report does not have a lot of other information on which to base a score. Opening several credit card accounts in a short period of time represents a great risk, especially for people who don't have a long credit history. Also, reaching the maximum level on a new account as soon as you open the account can have a negative impact. If you are taking out a line of credit for a specific purchase, such as a new washer and dryer, request a limit that is higher than your actual purchase. Even if you are planning on paying off the purchase within a short period of time, the account will always show that the limit and the historic high balance are the same. The importance of any one factor in your credit score calculation depends on the overall information in your credit report. For some people, one factor may have a larger impact than it would for somebody with a different credit history. In addition, As the information in your credit report changes, so does the importance of your other factors in determining your scores. Use these ratios as a guide to build a healthy credit profile, as well as a planning tool when making credit-related decisions. This has been Money Saving Minute number 009. It's your cash, and watching the Money Saving Minute each week will help you keep more of it. Click to the right to subscribe so you don't miss any of our money-saving tips, and click the Facebook button to share this with your friends. Thank you for watching. Check our archives for more money-saving tips and click subscribe so you never miss a post. For more information about financing the home of your dreams, refinancing your current home, 203K home restoration loans, or loan options such as no PMI conventional loans, FHA and VA loans, or first-time homebuyer education, please contact Dan Dahlen, Atlanta Mortgage Home Loan Specialist at 262-754-6473 or email dandahlen@atlanta.com.